this competition. I see a few familiar faces, which is good. We see some people from last year, at least mentors and advisors. So it's exciting to be back here in Silicon Valley. This was where I started my career. I actually grew up in the East Bay, so I'm from this area originally. And I started my career after my undergraduate years in the mid-90s. So in that evolution of Silicon Valley, I can't remember what wave that was, but it was sort of like just the transition from PCs to the internet. That was when I came to Silicon Valley. And I worked for a Japanese import-export firm that was mostly dealing with US tech companies exporting their products to Asia. So to Japan, Korea, Malaysia, Singapore, Australia, basically covering most of Asia. And I worked in the networking products and data storage products. Cisco is a company that we also know that's still around. Most of the other companies I work with are gone, like 3Com, Bay Networks, and other little tiny companies. We worked with big companies as well as small companies. We would look for new technology for both potential investment opportunities as well as the chance to take them to Asia. So we did market entry, consulting, and help. So how many of you have heard of InfoSeek? Anybody? Okay. Before Google, there actually were other search engines. You just don't remember what they are. So InfoSeek was one, Lycos, AltaVista, Excite. Yahoo was not a search engine, it was a directory. They thought that they could organize all of the internet into one sort of directory structure. That was wishful thinking based on how big the internet has gotten. Anyway, we took InfoSeek and helped them convert to a Japanese language search engine. And in fact, there still is an InfoSeek Japan as a search engine in Japan. So got to see a lot of interesting things in that period. I went and did my MBA, came back to Silicon Valley, did consulting after that with tech companies, both small startups and bigger companies. And that was as the dot-com bubble was crashing, collapsing, and there were companies that hadn't taken investment money that didn't know what to do anymore because their first idea wasn't going to work. So we helped to consult with them to see if it was worth doing anything else. And again, saw a lot of interesting things in that time period. I went through the highs of joining a company that had been merged with another company that had venture capital backing, and we all had stock options, and it was going to go public, and we were going to make all this money. And then it didn't happen, and they went bankrupt instead. So I saw the highs of thinking about making all this money, and then I saw the lows of going bankrupt, which was also interesting. Started my own practice after that, and then went back and did a PhD in Texas before going to BYU. So that's my journey to this place, which is, surprisingly, it seems as I look back fairly short, but it's amazing how long some of these journeys take. So today we're going to talk about dividing equity among founders and investors. Again, this is a really complicated topic, but it's important for everybody to think about because you all have promising ideas that will probably likely need some sort of funding at some point. And it's easy to get yourself into trouble if you don't really think about all the complications. So back to this QR code thing right here. There was a major startup that came out of BYU about 6-7 years ago called Scan. And they had 3 rounds of financing, actually got to be fairly big. They had an app that was just a QR code reader app, but also had other services around generating QR codes for businesses and things like that. They got acquired from Snapchat for about $45 million. Pretty impressive for an app that just scanned QR codes, but somehow they pulled it off. The interesting thing is there were three founders in this venture. They took a total of about $15 or $16 million in investment funds. And surprisingly, even though it sold for $45 million, they actually didn't walk away with very much money. And that's part of the lesson related today, which is there's so many things that can happen in dealing with outside investors that can affect how much money you still own, or how much of the company you still own at the point where you actually can cash out. So a couple things. So I want to talk about resources that I've referred to. So Founders' Dilemmas is a book that I'll talk about here. Today we'll focus on kind of the reward dilemmas, which is how you split up equity as companies, employees and founders, and then investors' dilemmas, so dealing with the challenges of outside investment. I use this class in my MBA Managing New Ventures class. It's nice because it's data-driven. It's got about 500 surveys of entrepreneurs that are the basis for most of the findings in this book. The core dilemma is, do you want to be in control of the company or do you want to make a lot of money? And we'll talk about that later. There are some other resources I'll get to as well, but first let's talk about sort of what you need as an entrepreneur. You need some know-how, capital, human capital. social capital or connections to help you get other resources, and then financial capital, the money piece of this. So you can use your direct contacts, your indirect contacts, or you can just do an open search in the market. So how many actual teams of entrepreneurs do we have here? Like you're actually all in the same company. Raise your hand. So we've got a team of 3. So a team of 2 here. So yeah, if your partner's not here, that doesn't count because that means you can say whatever you want. Come up with all these kind of plans while they're not here. So the 3 of you, or is it all 3 of you? Okay. So how did you all meet? What's your connection? Okay. So colleagues in college and friends in high school. Cool. How about you guys? What's your connection? Okay. So you met together in college. Okay, good. I'll come back and we'll look at our survey in a second, but most ventures take teams. In this book, only 16% of the 500 companies were solo founded. Most of them were team founded, which means you're going to have issues around teams, figuring out how to divide equity, divide roles. Also, you're going to have to split up that equity if you try to bring in other people later. So how many of you have brought in people after you originally started working on this? So sort of later stage founders, whether they're employees that you're giving equity to or they considered them as founders. So you've brought in somebody else. So often the farther you progress, the more you're going to need to think about bringing other people as well. So what are some of the key decisions you have to make? Your roles, how much time you're going to spend on this and what your job is going to be as founders, what your titles are going to be, how you're going to make decisions. So do you all have titles? What are your titles? Okay, so the CEO at least knew his title. That's the most important one. So the CEO knew he was the CEO. But the rest of you are just called co-founders? Or the CMO, okay. Operations, okay. So you know what your jobs are, more or less? Yeah. Yeah, so this is actually sort of artificial when you're talking about a startup where you really have to just cover whatever happens. You put out the fires wherever they are. So it is artificial, but it's at least important to have a general idea of who's in charge. So what's the 4th person who's not here? Okay. So everything else, he just does. Okay. So he's sort of part-time. He's like the consultant to give you guys credibility. Yeah. He's a strategy person. That's the best job to have because it really doesn't mean anything. I taught strategy for so long. I really like strategy, but the problem with strategy is it's really easy to think up cool ideas, but really hard to actually do them. And so, strategy has to get translated into something at some point. Okay, the other thing we need to worry about here is equity stakes and compensation. So is anybody here actually paying themselves based on what you're doing yet? Okay, that's good. Yeah, if you are, that means you may be short-sighted because there's probably more important things you could be doing with your money. But for now, so today we'll focus a little bit more on equity stakes. And I'll skip over the survey. Well, actually, maybe I can get to it fast. Let's see. Okay, so let's look at this just quickly. Okay, so how many founders on your team? Wow, 40% have fairly large teams. Oh, you guys can't see that. Do you guys want to see what I'm looking at? It'll be more interesting. Let's see, hold on. Okay. All right, so 40%, so 40, let's see, let's go back here. Founders on the team, 40% have 4 or more, so that's actually surprisingly large. 25% of you have 3, and we only have 1 solo founder here. So you see fairly large teams are typical, which is good. Prior connections, largely friends working together, then classmates it looks like is next, and then coworkers. Again, so hopefully
the friendship is the basis for a long-term successful business relationship and not like the start of the end for your friendship. Actually, I think friendship works well because I think it actually helps you overcome the challenges and the complications you have as you try to work through things. Have you resolved this structure? Let's see. So 30% have formalized it. That's good. 40% have decided but not yet formalized it. And only 10% have not yet really discussed it. So it sounds like most of you have had this discussion at some point, which I think is important. And it typically comes up about the same time you try to make up a name for your company. Then you sort of say, all right, now who owns how much of this company? We'll talk about sort of your approach. So mostly self-funded, it looks like, and competition, so we'll hopefully add to that. But it looks like you're all before the stage of taking outside funding. And let's see. So your estimates on how much you'd give away in your first round of funding between 5, it looks like 15 to 20% is the modal category, which actually that's a pretty good estimate. Okay, so just wanted to get a little bit of data on what you guys are thinking and what stage you're at. All right, so challenges with equity splits. It's going to affect things like actually how much money you make, and how many of you care about that? It's okay to care about that. Obviously, it may not be the most important thing, but it is going to affect how much people take away from this if it's successful. But it has, more importantly, symbolic effects, sort of who really is in charge, what does it mean in terms of your contribution, how that's valued. How many of you have ever felt underappreciated in your life? Honestly, you guys all feel really appreciated. I've felt underappreciated before. I do a lot of technical work, and nobody understands like the technical work if they're non-technical. They think, oh, like, just go do that, and they think it'll take 5 minutes. And it actually takes you like 3 hours, and then you show it to them, and they don't realize it took you that long. And you feel like they just don't get how much work goes into this. So there's all these opportunities for people to feel underappreciated. If you only get 40% of the company, and your partner gets 60%, and you feel like that's not fair because you're working harder, it creates this tension. So something to think about. One thing I'll say is there's not a need to rush. So even those of you who have actually come up with some to split, there's no reason you can't renegotiate, at least at this stage, because you haven't really formalized it even if you've written it down on a piece of paper, as long as you agree to it, you can all change your mind about that. It gets really complicated when you start to have outside investors, though. But the goal is to avoid mistakes, avoid setting sort of inappropriate starting points, and keeping your options open so everybody's motivated. But again, at some point you have to do this. If you start taking outside funding, you have to decide who gets what. So, criteria for splits, the idea. If you came up with the idea, do you think you deserve more? Raise your hand if you think yes. Idea person deserves more. Are you the idea person? Okay. So if you're an idea person, you're most likely to say that it does deserve more compensation, more equity. But you could argue that execution is more important than ideas as well. Ideas are fairly cheap. It really depends on how solid the idea is and how well developed the idea is. The actual data suggests that people who came up with the idea do get about a 10 to 15% premium in terms of equity stake. So there is a little bit of an idea premium based on some of the research. How many people do you know? Is your network really cool, big, important? That actually can make a difference, especially if you start bringing in important connections. So I have a small software business on the side, and I have one partner, and we initially decided on a 60-40 split, mainly because I was going to do most of the work developing the simulation business, and he was going to help with the content. He decided, though, that he had a really important connection that was going to get us all these new customers, and he said, well, why don't we make it 50-50? And I was agreeable and said, okay, that's fine, let's make it 50-50. It turned out that his connection was not very useful in the end, and it was sort of it was a promise that didn't end up coming through. But that was actually okay, because 50-50 ended up, for us, being not bad, because I think he does put in about 50% of the effort now in terms of dealing with new sales opportunities and new customer contacts and things like that. Things do matter, like how long you've been working on the business, how much time and energy you put into the business, part-time versus part-time. Are you a McKinsey consultant most of the time, while the rest of your partners are doing all the work? So hopefully he's really valuable when he does jump in. Have you guys figured out your split yet? Okay, so it's an equivalent shares. Yeah. And you're all still happy? The CEO is happy. But this is your chance now. While the McKinsey guy's not here, you can make some decisions, because three can outvote one. A lot of the question is financial capital. How many of you have put your own money into your fund, into your businesses up to this point? Okay, so this can make a difference, especially if you put a lot of money relative to others. So all these things can come into play as you determine splits. Other things, future contributions, which is how much time will you continue to put into this? What will your roles be? Will you be the CEO? And what other connections will you bring? The problem is when you split the pie, most of this is still unknown. You really don't know how much work people are going to put in, what's going to happen, how committed they're going to be, which is why often this needs to be renegotiated. And things like opportunity cost. If I'm going to quit my job at McKinsey, I may want more than just 25% of your company. I'm going to want 40% or something. And then what are my motivations? Do I want to have a nice, relaxing life, or do I want to really work hard? Those things can all come into play as you make these decisions. So starting point is often, do you want to have an equal split or an unequal split? That's the easiest place to start. Do you do a 3-way equal split, 4-way equal split, 2-way equal split? What do you think? Is there a benefit of having equal? So what are the upsides to equal?
I've read a bunch on this. The article that says the only wrong answer is 50-50, and this whole idea that you should split things up based on people's input and over the first year or so.
Yeah.
And the idea of being equal, there's a whole other counter argument saying, you know what, it's okay if you have this understanding up front, it creates the perception of fairness. And there are a whole bunch of other benefits to that. Just psychologically, we're okay with this, and I'm actually tending to just do things that way and put up a much more defined getting out of business process, and make sure that if one of the founders, my friend, wants to leave, that we have a very well-defined system for doing that, so that no one's feelings are hurt and we can be friends forever.
Yeah, so exit strategies are important because often that's where you have to make the hard decisions, which is how much did you really contribute, and is this going to be a friendly exit, and how much do you deserve to take with you? So you bring up a good point, which is if you make it equal, then you don't really have to argue about it. You just say, we believe we're all equal contributors here. Let's just go with that, and then you don't have to spend days arguing about it. Anybody else? Benefits of equal or unequal? Yeah?
Well, we use it of unequal argument. That is why you can turn it without. So, setting equals works. You give everybody the chance to prove that they're but if they're not, you need at least what to do.
Yeah. I like that idea. It's sort of setting an expectation as much as it is recognizing the contributions. The expectation is you're all going to work to demonstrate equal contribution to this business. And you may do it in different ways. Again, I feel pretty comfortable with my partner being 50% because he steps up and does a lot of things that I'd rather not do, so it works out fine. It is, a way to avoid conflict and tension. And it signals, we're a team. We view ourselves as a collective team rather than fighting against each other. It's better, though, if you're doing it not just to avoid conflict. Because if you're trying to avoid conflict on this, you may end up trying to avoid conflict on other things, which leads to other problems. Sometimes there is clear differences, and may be worth negotiating those out. The other thing is if you come to a slow equal, that means you've thought about this for a while, and then you decided it should be an equal share, which I think means it's a little more meaningful. 51 versus 50%, so sometimes they'll just make it a 51-49 split just so it's clear who has the final say in decisions. Oftentimes at the early stage, it may not be that critical, especially if you're friends, you can probably come to consensus. But there may be cases where you disagree so hard that you need somebody to be the final decision maker. But that's it suggests that you may have difficulties other than just your ownership stake. The other thing is eventually that may not matter anymore because you bring in board members that now have voting rights and other decision-making powers that are different than what you have in your equity splits. So, and again, this will all change as you start to bring in more people, as you bring in employees and start to share equity with them too. Other things, do you make this formal or informal? Is it a handshake or is it a written document? Do you involve attorneys in doing this? How many of you actually have attorneys that have helped you so far? Okay. So attorneys can be helpful. Attorneys can also complicate your life, especially if they don't really know what they're doing in this space. So if you have an attorney, make sure they're a good attorney who knows what they're doing. Does it have to be static? Can you change the ownership over time? I think it makes sense to have things like milestones and performance expectations built in that allow you to change the equity stake. It can be through vesting, it can be through milestone accomplishments, but things may change. This is where contingencies come in. Again, if things happen, what are you going to do? Particularly if people decide to exit, how are you going to work that out? And ideally, it's worked out as a friendly exit rather than bringing in the attorneys at that point. But I do have a number of students I've worked with who've had to bring in attorneys to get rid of people that thought they were adding a lot more value than they were. And that's the problem. When you start to disagree on how much value you add, then you get these complications. And again, some people want cash more than they want equity. This especially comes in as you start to think about employees. Can you get away with not paying your employees and just giving them equity? That may be great. It's risky for them, but then you also have to ask, how many people do I want to have as shareholders? And how much of the company do I want to give away to my employees? And lastly, vesting. Vesting will come up again as we talk about this later. Sometimes, though, we have this issue, which is, I think my idea was worth more of a stake, therefore I want it to be, if you have a patent already, for example, you may not want to have to vest. You think you've already brought the value. The reality is most value comes over time, so you need to keep working with this. Things change, be able to be flexible and deal with the change. So non-founders, equity is basically your currency, and this is how you're going to bring in other people. In some cases, they're founder level, maybe not founder level, but important employees. So you can trade your equity for value and human capital. The same rules apply, thinking about what's the contribution and what's the right share to give away to them. Okay. So now let's shift about bringing in outside money. So you figured out how to share the equity internally. You're all happy with that. You like that. At some point, you may need outside money. And bringing in financial capital can come in a lot of different ways. So you can self-fund. This is the safest in terms of not having to give up control. You can go to your friends and family. And here's a quote related to that, or a comment related to this. It's best if they think that that's a lottery ticket, your friends and family, rather than thinking they're actually going to make a lot of money. Because that way, they're not going to be expecting necessarily to get all that money back. Sometimes, I think friends and family can make that investment comfortably, but a lot of time they get so excited about your idea, mainly because they think you're going to be super rich and famous, and they think you're going to give that money back someday, which is probably, in this case, in this group of people, probably likely, but for a lot of people, it's not very likely. So as long as they know that they may not get their money back, and they're not going to bug you every single time they see you to ask how your business is doing, those are probably okay criteria to allow you to have a friends and family investment. So we'll talk mostly about angels and VC investors. You can also get strategic equity investors, so other companies. And then all these random things. You can do crowdfunding investments, banks, loans, bootstrapping, pre-sales on Kickstarter, and you go all these other ways to get money. So part of the thing to think about here is, do you really need to go to an institutional investor or not? Maybe you do. And if you need a lot of money, it's often the best way to go. So the last two groups to talk about. Lawyers are important, especially if you want to do complex things. So I don't think I do any of this in terms of dealing with VCs without an attorney on my side. Mentors and advisors. So advisors tend to be paid. Mentors are not paid. Mentors are probably better than advisors. Mentors usually do this because they want to give back, because they've succeeded in the past and want to help other people. Advisors may not have as much experience and may be trying to make quick money. So again, if you can find a mentor rather than an advisor who wants a share of your business, you're probably better off. Okay. So jumping over to the idea of the deal with an investment partner like a venture capital firm or an angel investor. This is the primary resource that I'm going to work from, which is called Venture Deals. That's the 3rd edition. This is the 2nd edition here. So if you want to get down to the details of a term sheet and dealing with a VC, this is the best book out there. But there are a lot of other resources, and this is what I'll email you. They have a website connected to this book that has sample term sheets and other documents. Y Combinator also has documents, and they have something I'll mention later, similar to a convertible debt note idea. How many of you use Crunchbase? You know what Crunchbase is? So Crunchbase is a really good database of American companies and the funding that they've received. And it's actually amazingly complete. So almost every small business that's taken VC funding is in Crunchbase. So you can actually get really good data on how much companies like yours have already taken. So it's a great resource to look at. And then this is, if you really like this stuff or thinking about doing this anytime soon, Brad and Jason are actually doing an online class for free from May 14th to July 3rd. So you can actually go through this whole book online and get all the details that they're talking about here. So again, really useful. Probably, given it's free, it's online, so I'm assuming there's no limit to registration, so would be something I'd recommend. And then CapShare is another resource that I'll talk about that helps you manage the ownership structure of your organization. Okay. So do you need funding? How much do you need? This is a good baseline rule, which is everything will take 3 times as long as you think and cost you 3 times as much. The point of this isn't necessarily to estimate how much it's going to cost, but to remind you that you're always going to need to overestimate in order to even have enough. Sometimes it's even worse than this. So this case, the guy who tried to build this recumbent bicycle ended up spending 100 times what he thought. So he thought he could do this in 3 months for $30,000. He's actually been working on it for 10 years and spent $3 million on this bike. Now he's made a lot of money in other startups, and that's what you can do, is you can spend a lot of time on hobbies after you've made a bunch of money. But even for experienced entrepreneurs, this is a lot harder than you might think. Okay, so before we get into the process, the important thing to think about is this core dilemma of, do you want to be wealthy or do you want to have control? And in making the decision to bring in other investors, you're often making this trade-off. You're typically giving up control in the hopes that you're going to become wealthy because the outside investor will enable you to grow faster than you could otherwise. How many of you think your preference would be more for control? Like you want to control your business. And in this case, control means you stay in as the CEO, you control the board can't force you out. How many of you are okay with giving up control of your company, you think? Okay, so there's a bunch of you in the middle. Here's some interesting data. So this is based, again, on the companies that were surveyed for this who actually had exits or valuation events that they could use. Those who were willing to give up control, both CEO and board control, who were wealth-oriented, they actually ended up, the value of their shares of the company ended up being about twice what it was for the people that wanted to keep control, who wanted to stay in as CEO. Any thoughts on why this might be? Yeah.
It's not self-selected, but the people who are able to raise outside money, that's smart people saying this company actually can grow, and I'm going to come in and I'm going to help it grow. So there are people who are going to both identify whether or not it's a good investment, and then they may be able to increase the value of the investment by being smart advisors.
Yeah, I mean, in this case, though, all these companies took VC funding. So
you're saying that the 3.2 million shareholders, they also took funding?
Yeah. In all those cases, they gave up equity in the firm. They just made sure they stayed on as CEO and kept board control. So they were all funded, but the value of the company when they exited was still less. Yeah.
I think because a founder can take a company up to a certain level, and then after the months, it's different than a CEO who can grow the company faster.
Okay, this idea that we're good at some jobs, but we're not good at every job. And at some point, as the company starts to grow, you need somebody who has experience or the ability to take it to the next stage. We may love an idea so much we don't want to let somebody else take it. It's like giving our kid away, our child away to somebody else. That's really hard to do. But in many cases, it may be the necessary thing to do to keep your company growing or be successful. So given this, again, they're still fairly successful. Some people just want to bootstrap their business. Some people never want to take outside VC funding, and that's actually probably okay if you can do it. I think if you can avoid what I'm going to show you in a second, which is the complexity of a VC term sheet, you probably would want to. But not everybody can bootstrap their business. If you do need the money, where do you go to get them? This is also data from the 500 entrepreneurs that he surveyed. Most of them, this is interesting, VC investors are actually easy to reach through cold calls, so about 21%. So you can actually send your business idea to a VC investor and sometimes get an audience. Most of the angel investor contacts came from personal networks, so people you knew, friends or family contacts as well. So finding them is important, but making sure that the right ones is most important. So again, make sure you get references, see what companies they've funded before and how things have gone with those fundings, because like everything, not all things are created equal, and some things are going to be better than others. So first step is deciding that you're going to do this. So there is do or do not, there is no try when it comes to fundraising. If you're going to do it, try it, but that means you're actually going all in to get it done. You may not succeed, but at least you're committed to doing it. And if you're not fully committed, it may be signaling that you're not really fully committed to the idea anyway. So first of all, have a number in mind. Is it 500,000? Is it 200,000? Is it $5 million? But what is that number? How much money do you need to get to the next milestone where you could raise money again is the key question. That's really what you're trying to answer here. And what is that next milestone is the driver of that. So for example, if you need to get to shipping products, to do that you're going to need 8 people in your company. That's going to cost you $100,000 a month, and it's going to take you 6 months. So that would be $600,000 right there. So you could raise $1 million so you have a cushion. So something like that. It doesn't need to be a super complicated spreadsheet to figure this out. And it's more about, again, being specific and picking an amount rather than having a range. So if you say I need to raise $1 million to $2 million, I, as an investor, am going to say, well, what's the difference? What are you going to do if you have $2 million that you wouldn't do if you had $1 million? So what's the difference between the two? You can always negotiate that, but it's more, I think it's more effective to say what you want and go after that amount. Okay. Once you've figured out what you want, you find somebody that may be willing to invest in you. What this all comes down to is term sheets. Term sheets are fairly basic agreements that state what the blueprint for a relationship is going to be like, and they address 2 major things. So one is the economics, meaning what's going to happen when there's an exit event for the company, and then how much control are they going to have over the company. So these are the 2 factors we'll talk about. And I'll just show you a sample here. So this is a sample term sheet that you can actually get from that Ask the VC website. So you'll see it has a financing amount here. It shows, this is where you get the valuation. So it has a pre-money, post-money valuation listed. Then it has things such as the board of directors composition. And then it goes on for about 5 pages with lots of terms and specifics, which is what I'll talk about here. A lot of this is boilerplate. You negotiate the details, but it's actually not that complicated. So the first question is, what's the right valuation for your company? How much equity are you going to have to give up based on that valuation and how much money you need? And this is, there is no way to predict this or come up with this number exactly. A lot of things come into play. So at the early stage, it's what's the opportunity? What milestones have you completed? Do you have contracts? Do you have a minimum viable product? I know you've probably all heard this, but if you don't have something that sort of demonstrate that you really have this problem solved, if you go to raise money, you're going to have to pay quite a bit of money in terms of equity for that. So the farther along you can get, the better your valuation is going to be. As you get to later stages, they start to look at other more detailed performance metrics. If you have VCs competing for you, that's better. The more competition, the better in terms of increasing your value. The more experience you have, the better. And the economic climate. There are certain times when VC fundraising is easy to do because there's a lot of money available, and other times when it's really hard. But what I want to show here is a little bit of data from the industry. This is West Coast, US-centric data, and it shows you kind of what happens generally in investment rounds. Whatever happens, though, remember you're negotiating, so it's nothing to say about you failing or being good with the actual valuation. Okay, so how much is actually given to investors? Again, you guys said about 15 to 20% in your first round, which is pretty good. We had pretty good spread, though. So this is actual data. Before you take in outside money or when you take in debt, convertible notes, by definition, all the founders still have 100% of the company, founders or employees. Seed round, on average, giving up about 25% of the company. Series A, after Series A, typically the founders and employees still own at least 60% of the company. So it's not until Series B typically when small companies start to give up the controlling interest in the overall shares of the company. So it sort of goes downhill like this. This is valuation, and the yellow is mean, so the average. Blue is the median. So blue is probably more useful to look at because this means half the values are above and half the values are below. So seed round for median looks like it's about $2 to $3 million. Even that may be a little high. So seed round tends to be $1 to $3 million. Series A is about sort of $5 to $6 million in median, and then it goes up from there. So there is sort of these benchmark ideas about how big or how much opportunity your company has to have for the investors to be interested and the valuation that they need to see to make an investment. Okay, here's a question. A VC says to you, I'll invest $5 million at a valuation of $20 million. What does that mean? Okay, so it could mean 20%. Okay, that's the question. So is this $20 million pre-money or post, or pre or post? And that's the key thing you need to figure out. So pre-money valuation, if it were $20 million pre-money and they gave you $5 million, they would have a 20% stake. But if what they really meant, which is probably what they were saying, was we'll give you $5 million for a post-money valuation of $20 million, then they actually end up with a 25% stake. So again, this is not complicated, but it's something that's just complicated enough that we can ignore it or forget about it. So always be thinking in terms of pre-money, post-money. And basically, you can value your company today, and then whatever money they add to that, you add to that value, and that gives you your post-money valuation. More often, though, they're going to give you an investment amount and say they want a certain stake of the company. And then you can back into your valuations, your pre- and post-money valuations. So if they said, we're going to invest $5 million for a 25% stake in your company, by definition, that means your pre-money valuation was only $15 million, okay? So if they said that, what you should say is, I assume that you mean 20 million pre-money, so make the presumptive close in your favor that then they can either say no to or they may say yes. So the problem is, if it were that simple, it would be great. You give me $5 million, you can have 25% of my company, it's great. We'll go public and I'll have 75% of the company, you have 25% of the company, or we'll sell the company and it'll be great. The reality is, there are a lot of details we need to worry about. So first of all, the shares that we're talking about are common shares for founders and employees, and then preferred shares for the investors, which means the investors are getting something beyond just ownership. They're also assuming that all the shares are fully diluted when they take their share, which means if you have an option pool, and if you create sort of a cap table for your company, typically you need to set aside some number of shares, and they usually come out of the founder shares, to pay for options for employees, assuming you're going to use that as part of your motivation, which is the assumption and expectation. Typically, that's 10 to 20% of the overall equity in the company. So that's quite a bit of equity in the company that the VCs are going to expect you to give up as you start to bring in their money. If you can keep it at 10, that's probably better. And bringing this up at the early stages, deciding beforehand what you want to do. So if you have so in your case, you guys have a four-way split, 25, 25, 25. You could make it 20, 20, 20, 20 if you wanted to give 20%. That may be too generous. You could make it 10, and then 17, whatever, 22 and a quarter or something like that. Setting it up earlier gives you some power when the VCs come to say, we'd like to have a 20% option pool. You say, no, we've already thought about it. We have 10%, and we think that's sufficient. Okay, so again, there's other shares you need to set aside that are going to take away from your overall equity, but potentially at some point. Then there's liquidation preferences. So company invests in you, give you $500,000. That's great. But there's also this liquidation preference, which means that say somebody buys your company for $500,000, if they have a liquidation preference, they basically can keep all that money. You walk away with nothing regardless of how much equity you have. So again, liquidation preference is important if there's a liquidation event. So this is an acquisition, a merger, or where they basically sell the company. So in those cases, typically the investors have some ability to collect the money first, and you just get what's left over split up based on equity. Typically it's 1x, so if they invest $100,000 or $1 million, that's what they get back. It's gone as high as 10x, which is just insane, because that's basically guaranteeing, even if you do really, really well, all that money is going to go to your investors. But even 1x has implications. The other thing, it doesn't imply if there's an IPO. So if you go public, that's a funding event. So they don't guaranteed get money back in an IPO. This usually isn't great, though, because unless you do really, really well, there's not going to be as much money left over for you. So that story I told you at the beginning about the guy who invented the app to read QR codes, a lot of these things came into play, and I think that's why the investors ended up taking most of the money from that. So he may have had something higher than 1x in terms of his liquidation preference, for example. But investors don't want to demotivate you, but they do see this as a way to say, you know what, the only way you're going to make a lot of money is if you go really, really big. So you have to swing for the fence, try to hit a home run, do something really amazing in order to get enough money back that you're now going to make money on top of what they're going to collect back. So other things come into play as well. So on top of the liquidation preference, they can also have what's called participating rights, which means they get all their money back, and then they start to take a share of your common equity as that's just divided up. So say they had $500,000 preference, and they own 40% of the stock. If you sold your company for $1 million, they would take the $500,000, and then they would also take 40% of the other $500,000. So bad deal, because they not only get $500,000, they get another $200,000 on top of that. So again, little things like that in these term sheets with your investors can make a big difference. Another thing that seems like a sort of a negative deal is vesting. So you may have started your company. So how many of you have been doing this for more than a year? Working on your company for more than a year. Okay, so if you've been doing it for more than a year, maybe you're lucky, and what will happen is you'll get a 4-year vesting schedule, but you'll get 1 year of that credited to you. So you take the money tomorrow, you own, say, 50% of the company, but in reality, you only own 12.5% of the company until you vest the rest of that. So you've worked all this time, and all of a sudden you're now giving back ownership that's contingent to the investor until you work it off. So something, again, to think about. The goal of investors, though, is to help you stay motivated to stay with the company, because they don't want you to sort of get in and give up. You could do things like get the right to buy back the shares if there is an event where they fire you, they somehow get you out. But again, typically this is a requirement of outside investment that you're not going to be able to negotiate. Does this seem fair? Any challenges, this sort of negatives you guys see here? You think it's fair?
I see some positives in the idea of investing helps when you're talking about dividing up ownership between founders. So rather than just bring on an investor, even without an investor, investing could make sense. I would also think if you're investing, then like who owns that ownership? Like between two partners, if they're each 50%, but they're gaining a quarter of that each year for the first 4 years, then where does the rest of that equity go?
That's a good point. So if it's unvested and there's an event, basically it just disappears. And the investors who are vested, basically it's reverse dilution. It gives them more of the company. So they win. But I think your point's right in terms of motivating. Vesting always is intended to be a motivational factor to help people stay focused. Again, it's trying to get everybody aligned so everybody focuses on working hard over time. Other small things like if you have a second or third round of funding, sometimes you'll have to bring earlier investors along. If there's a down round, that means the valuation goes down from one round to the next. There can be anti-dilution, which basically means you're also going to give up more of your company. So these things, again, there's a lot to learn, a lot to figure out. I would say spend the time trying to figure out if you decide to go down this path. But this is mainly to highlight what can be challenging as you do an equity investment. All right. Control comes from board seats. Typically, in an early VC round, they'll do a balanced board, which means one founder, one VC, and one outsider, or they'll do 2 founders, 2 VCs, and 1 outsider. So equal decision votes on the board, plus 1 outsider as the tiebreaker. There are also other things they do that give them rights to veto any decision. So they have the right to basically make sure nobody does anything they don't like. And if they want to sell your company, they can drag everybody along as well. So they basically can force you to come along with them. And they convert their shares if they want to. Basically, all these things allow the investors to have protections over their money that they put into your company. So you're giving up control by bringing in outside money. And then there are all these other terms that are in there, too many to mention. Things like agreements on intellectual property rights, no shop, meaning you can't go try to find another investor while you're discussing a deal with a VC firm. rights of first refusal, so if you go to raise another round of money, you have to give them the right to invest first. Sometimes they'll request dividends. There are all these other things that have to happen, conditions precedent before they'll close on the deal. Again, lots of things to worry about. The point here is you got to be careful in what you're doing and pay attention to the details. All right, one last thing I want to hit on is an alternative, which is convertible notes. So convertible notes are a common way for early stage investments to be structured because you don't have to value the company. Basically, somebody loans you, they give you a note for $200,000, which will convert to equity at the first investment round after that with a discount. So the discount means, typically it's something like 20%. They give you $250,000 with a 20% discount. You do an investment round at $1 million. They come in at $1 a share. Your $250,000 would be discounted to 80 cents a share. So they would get $312,000 worth of the company. So that's how they get their return at the investment round, is because of this discount. The nice thing about this is you can make some assumptions about value, and you use those sometimes to set a cap on the value. So you have a specific maximum value that you could use for this. Sometimes they'll have interest rates as well. So there's upside in terms of being easy to do, and you don't have to worry about valuation. The complications can be that this is debt, and it shows up on your balance sheet as debt, so there are other implications there. I just mentioned here that there's another way to do this that Y Combinator is promoting called simple agreement for future equity. So it's exactly the same as a convertible debt note, except it's not debt. It's basically, they give you the equity, but they don't value the equity until your next investment round. And so it works the same way, but it's not called debt. So again, the links I'll send to you will have that in it. All right, the last thing to worry about is a cap table. And this is just to highlight how complicated this gets as you start to add more and more investors to your business. A very simple one, if you have just founders and employee options, you have initially 2 million shares. They decide to create a 20% option pool, and the VC firm wanted a 33% share for $5 million. All of these things come together and actually create the, you work backwards to figure out the shares and the ownership percentage. This is easy for one round, but it gets pretty complicated very quickly. And this is a very simple cap table, but showing multiple rounds, multiple founders. So each founder has a separate line with their equity. And you'll see over time how the founder shares go down as they go from friends and family to angels investors to VC round. So this is necessary as you start to bring on other investors and keep track of what their valuation, the valuation is of their portion of the business over time. So most of this is manageable. It just requires a lot of attention to detail and consideration of the challenges you're going to face. So again, coming back to the resources, walking through really this book, and I'm guessing by going through their class, will give you a good understanding of all these specific topics that I'm talking about. And whether or not you decide to take venture capital, I think you'll be a lot more informed as a potential entrepreneur taking on outside money and investment. So, any questions? Yeah.
Just a question. What have you seen in terms of when they incorporate a company, in terms of setting up their shares for like the initial incorporation?
Yeah. So yeah, if you do an LLC or something like that, you will have to set up an ownership percentage there. And that's where that initial decision around how do you divide the equity among the founders is most important. I don't know, I think you can renegotiate some of that as necessary. That's not that difficult to change if everybody agrees to the change in structure. But at some point, specifically there, you are going to have to formally decide what it's going to be particularly if you go with a corporate structure where you have to divide up the equity ownership of the corporation. So. Yeah. Typically the founders will all just do common shares. Maybe if one of the founders brought in equity or did something a little more involved, then maybe you'd see more. But there's typically not different classes of shares at that stage. Yeah. Okay. Any other questions? All right, be careful out there, but pursue what you need to get the money you need. Because I think, again, wealth requires giving up some control and making some of those trade-offs at sometimes. Just be smart when you do it. So anyway, thanks and good luck with everything, you guys.